Can I tell the future? Hindsight 2020 is so hard once it's happened, unless you take somebody off the street and then you show them a chart and then you start moving it along and you say, would you have entered short here? It's hard to tell how I would have fared back then if I would have called this back in 2015, if I would have said, oh, end of the world, Pat. First and foremost, there's your trading framework, your checks, check, technical stuff you're looking at before even considering. So that we could do that, we could apply that. But then there's that other facet, the emotional facet, which I think is very hard to reproduce because you have to be in the moment. How was Twitter feeding the news? What CNBC was saying at that particular moment? What your in-laws telling you? What was news, mainstream media telling you? So all that plays a huge role. So if your checks, your trading framework's telling you to short, but then after that you're hearing other stuff, you can not decide to short. You could have decided too short, or there's a whole bunch of stuff. So really, really hard to know if I would have been able to avoid that 2015, how I would have played back then, 2015, 16, would I have got trapped. So other than that, the emotional aspect, I think I'm going to give it a go. And I want to see what I'm doing right now, for my trading framework right now, if I would have played that. And I know that even if any trading framework, you get even if everything checks out, the price action could go in the opposite direction. You can't control, you don't know the future. So that's why I use risk and money management. But let's go, man. Let's try it out. Because 2015, you've been going up for a while, and a lot of people could have been saying up here, oh man, this is a bubble. It's not normal. We've doubled. And look at that. We have. Okay, I'll do like I usually do. So now right now I'd say, oh, monthly defined. I have some monthly defined support. We close below it. Now I have some more monthly defined support right here. There's a lot of levels. See it? And I have even more here. So a whole bunch of levels of monthly defined support. This was actually pulling back nicely, contrary to the last run we had right now in 2017, 18. See, the closes of those red candles is telling me that that's monthly defined support. A lot of levels. Broke down the first one here, below 12-month moving average. Hitting that lower level here, that wick, noise below, price action came back up. But the next month we actually closed below that level and closed below that other lower level. So right here I could be saying, guys, oh, there's my arrow. Got a measured move. This is going down. How is am I declining? 12-month moving average? Yeah. So right here it started declining. 2054, 2051, 2047. It's declining right there. So right here at that stage, you know what I'm going to do? I'm going to put a vertical line. $12-month average going downwards. Price action below 12-month moving average. I got a measure move here. Bring me all the way down to these levels right here. All right, so on the monthly chart, the trend is downwards. We're starting to go downwards. And I could have been starting to go crazy and do my Fibonacci and tell you guys that, oh, this is pulling back all the way to 2009 lows. We're going back down here, vacuum all the way to 1400. Where we start to have a sideways zone, previous resistance turned support. And after that, 6 to 1%, it's in the middle of a congestion area. So I could have easily told you, hey, this is going to easy pull back all the way back down to 1400. But is that enough to enter? Would I have entered right there? The more weight of evidence, the better you're off. Before pulling the trigger. So let's move back all the way to 2015. Where's my super duper line? Okay, let's remove that Ichimoku cloud. Okay, SPX. Oh man, the cloud. Pat. All right, there it is. Remove. Okay, 2015. Where am I? Up. Beautiful stage 2 above the Ichimoku cloud, above 30-week average, and right here. So here I had my monthly candle close August 31st. So it closed. I closed below the Ichimoku cloud. I'm closing below monthly define. My last link of monthly define support. I'm not closing below my weekly defined support. It's right here. I closed below with my weekly and my monthly here were the same. I closed below my monthly defined support. There's some more here. That's weekly defined support right here that we couldn't see. That was represented as a wick in monthly candle chart. Oh, look at that. There's a few things here. What about that volume? Right here, lots of damage. Hey, it's red. Red volume candle on that down day through that 30-week average. Not very good. Price action needs to recuperate a little bit. But this one right here, yeah, that's a big down day, big down week with increasing red volume. Not good. It actually looks smaller than it is because, check if I remove that big candle. Okay, it's not crazy red volume, but it's still bigger, pretty much bigger than the green action right there. 30-week average, is it declining? No, 30-week average is still inclining. Oh, okay. You cannot... Oh, okay, no, it's declining right there. So declining 30-week average, break below horizontal breakdown line, break below. Okay, price action, the Ichimoku cloud brought it back up. But right here, when we decide to short at that monthly candle close, man, for right now, doing stage analysis on the monthly chart, stage analysis on the weekly chart, classic chart trading patterns on the monthly chart, I'm getting a lot of sell signals right here. What else could I look at before declaring that this is the end of the world event? I'd like to see this candle right here, though. I'd like to see a little bit more details about that August 24th. Could zoom in on the daily. I want to see that green candle. Why are you zooming out? Bring me back. Whoa. Oh, there it is. Okay. What is the mess of that wick, guys? 24th. Okay, huge red day. Wow. Okay, so even there, I could have told you, look at that crazy red volume. You need damage, a lot of damage. So technically, if I would just look at the technicals, if I would just do charts and I say the price action is the only thing that counts, I would probably I would have shorted. But you need more than that. Stan had the weight of evidence, but he had these newspaper clippings. That comes back to what I said. Was there contrarian information that this was the end of the world? What? He'd also look at the advanced declines. So we could even go back here. Let's go see the advanced declines. Advanced declines? Whoa! Please bear with me. Object tree. Okay, there we go. Let's go take a look at the advanced declines. If we cross, this is the SPX. 2015. Yeah, you see we're below the zero line. We started going below the zero line in June. Oh, sorry. So right now, even the advanced declines, guys, we're going in bearish territory. Price action is so even more weight of evidence, guys. Right now, we're not getting there's not a lot of information here that's telling us that we can't, that this is not a short. Not that this is a crazy bear market or it's full meltdown, but that the index is starting to roll over. I haven't found any information. But there's one cool thing though that I discovered, or I did recently. SPX. Check it out. Check it out. Okay, let's bring back. There you go. There's my 2015. Where's my line? Where'd it go? I put it here. All right. Delete that. Economic data, guys. I've been looking at this recently, and what I'm looking for is overall economic data that's going to justify that this is really ready to go, guys. The payrolls, my final nail in the coffin that I look at to make sure that this is the end of the world. Because every time the payrolls, the total non-farm payrolls has started rolling over, we've went in a recession. It's a very, check it out. I'll just zoom out. You see here when it starts rolling down, 2001, when it starts really decreasing negatively. We're going into a recession. The market follows, declines. 2008, see January 2008, June already started rolling over before the 2009, 2008 crash. And that's what 2015, you see how it keeps going straight, and it's still going straight today. So even today now, I'm looking at the payrolls. I know sometimes it rolls after the fact, but if I start seeing it, rolling it before like it did in 2008, for me, that's a big, big nail in the coffin that, yeah, technically, monthly, on the weekly stage analysis, everything looks like it's going to break down. And if that starts rolling over, for me, that's pretty much a definite nail in the coffin that the weight of evidence is totally increased. We didn't have that back in 2015. Right here. Right here. That, I got to put it back. Sorry, guys. Vertical line. Right here, where I decided that this was I would have shorted technically, but if I would have looked at where are these numbers? So 141,900. Here, I'm looking at this right here. Total non-farm payrolls going up, 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 oh, up, up, up. Is there an area here where it declines? It keeps going up, guys. There's no clues here at all that this is gonna do a total meltdown. So right there, that economic data, I'm starting to really appreciate it. Really complements well the technicals. What else do we have right here? Okay, let's move it along like I didn't know that it existed. All right, here. Okay, I decided to short right there. End of the world. Still don't have a break. That's right now. I'm looking at the financial stress index of the Fed. You see in 2008 how it exploded. You broke out of this base, and after that, price action of the stress index exploded up when it crashed. Right here, you had that second level. When that exploded, it really got. In 2015, we don't have any of that yet. We're still way below these levels. Did I have another line? Oh, Uh, it went above here, but that month that we want to short, etching downwards, not really convincing, still in that lower area. So stress-wise, financial stress-wise, we don't have that economic data to confirm us that this is going to be a total meltdown. Unemployment rate, guys, it's still going downwards. It's not etching back upwards. Let's look at these numbers. 530, 520, 510, 5. It's still going downwards. And you want it. If I go back to 2008. Hold on, let me... Whoa. 2008 in September, October. See, it's really starting to crash. The unemployment already starting to go upwards, guys, and we don't have that yet. We're still trending downwards. So another economic data say, hey, the chart technically is telling us it wants to break down, but the final stress index is still holding at low levels. The total non-farm payroll is still increasing. No signs of slowing down. Unemployment rate still declining, not increasing. So I don't know, guys. All right, Fed's fund. This is pretty much the interest rate. And what do we have here, guys? In 2015, let's remove the noise. Pretty much flat, guys. Pretty much nothing happening right here. We haven't been in a cycle of increasing interest rates like we have before crashes, and then they plateau, and then they start reducing once the stock market starts going down. We're not even close to starting that yet. So another clue that it's not the interest rates. There's even the ones from previous 6 months, those hikes, nothing's impacting right now that market, the SPX. So nothing economically, what the Fed's doing, or what we see with the total non-farm payrolls, with unemployment rate, with the financial stress index, nothing is telling us that this economy is going to go bad, that's going to go into recession anytime soon. Nothing. All right. And this is the monetary base, guys. So there's no, still here, same thing. It's been increasing. There's no rolling over like we're seeing today yet that could provoke, look at that. Let's move it here. Here we are today. We've seen here the monetary base starting to quantitative tightening, starting to go down. And then you have some divergence with the higher highs, but monetary base is getting lower lows. You have the interest rates going up. We didn't even have that back then. So economically, the data is telling you that there's nothing underlining that's really going to drive that down, other than technically the stock market just needs a little respite, a little breathing room. And that's pretty much it, man. Without economic data, I think I would have been trapped. I would have got whipsawed. I would have lost my 1% of my NAV. I would have got trapped. I would have got whipsawed out. But using the weight of evidence and adding economic data, these 1, 2, 3, 4, 5 into your trading framework, for those bigger moves, you get a clue of, are we going for a full retrace? Could we start doing the doom and gloom talk? Until you have these indicators telling you that, yeah, okay, doom and gloom scenario is really close by, you got to say it's going to be a push, guys. And there's one more thing I could check. If you could bear with me. Let me check that out. It is monetary base. Edit graph. You know where I'm going. Add line. 10-year minus 2 years, guys. Edit line 1. Remove that. We don't want that. Okay, here we go. So what should pop up is a 10-year minus 2-year base. And look at that. Always that 10-year minus 2-year inverse or close to that inverted yield. And look at 2015. We're nowhere close. Look at that, the distance here. We're nowhere close that, yeah, sure, we're trending downwards, but we're not even close to the zero line guy, the inverse. So for to have a recession, which could really have a hard bearing on the market, we're still far away. So that would have been very, very hard to say doom and gloom, end of the world, because you have all that time. It takes time for it to go down this. Yes, now I could say that we're very close and something could be brewing up in the next 4, 5, 6 months, that we could be heading in a recession, that we have more doom and gloom elements, that, yeah, we could have severe retraces, full retrace on the SPX. But back in 2015, based on that, we didn't have all the elements. So sometimes you do got to look at the economic data. You got to look at the total weight of evidence and really get those clues if you're going to get faked out by a close below 12-month moving average, a close below 30-week moving average, and what seems just like a perfect short. Take a bigger look, guys. All right. Thanks for watching. It was a long one. See ya.